Today, we are going to be talking about accounting principles, specifically preparing for government contracting with public works. We are joined today with the professionals of Perkins & Co. Teresa here. Everybody say hi to Teresa. And our friend Alex with Barrett, Barrett & Co. So I'm going to hand it over to our friends here to talk to us about everything accounting. Thanks so much.
Yeah, thank you for that introduction. It's very, very good.
So thanks for having us today to talk about being prepared for government accounting and public works projects. As we all know, the big project on the horizon is the I-5 bridge connector, and based on the volume of work and the 8 to 10 years that it will take to consume all of that, I think we want to help the community be best prepared to make use of the capacity and the capabilities in this region to get a piece of the federal pie, so to speak. So what do you need to know to be prepared to go after government contracts?
Yeah, and so the ultimate goal with this presentation is to just do sort of an overview rather than go through on, take a deep dive on some of these topics. I mean, a lot of these topics in this presentation could be hour-long presentations within themselves. So it's just to get some exposure and
Awareness.
And just to have an overview of what you could be potentially dealing with when you're doing government work.
So our agenda for today, with that in mind, it's 1 hour to cover a lot of topics, including just foundational accounting basics to consider, the profit versus cash and the S curves of cash flow, understanding your working capital, preparing for outside eyes on your financials, and public works, industry, and state requirements, considerations for accurate estimating and bidding. And then we'll talk a little bit about good practices for monitoring your financial results. And lastly, we'll kind of wrap up with building your advisory team. So that's our agenda for today.
That sounds good to me.
So to start with, we'll get the boring piece right off the bat here, but if you can just follow standard rules on setting up chart of account structure, you'll be better served. And so this might be basic for some, but a little bit of new knowledge for others. Your chart of accounts is the complete listing of all the accounts in your company. It's used for recording and classifying transactions, but perhaps more importantly, it's the framework which supports your balance sheet and your income statement. It's a tool that you utilize to quickly identify direct versus indirect costs, which is important in tracking, estimating and how your jobs are coming in. And it also supports useful trend analysis for visibility to monitor your business and decisions that you need to make. So it's not just the books, there's some structure to that chart of accounts. How do we? So
Yeah, this is tough because the bar is over there. That works.
Okay.
Yeah.
So the recommended structure, again, this is not a time to be creative with chart account numbering.
Right.
It's a time to follow some guidelines, which means that anyone could come in from off the street and look at your books and understand what's in front of them. So you want to stay in the standard, which assets are accounts that start with a 1, liabilities start with a 2, your owner's equity and retained earnings typically start with 3, your income, which would be your revenue or your sales accounts, start with a 4, expenses for direct cost of goods would start with a 5 or 6, and then moving down to your indirect or overhead types of expenses for G&A start with a 7 or 8. And then the special reserve for other income and expense start with a 9, which highlight that they're outside of the normal operations of the business.
Yeah, so I typically see 4-digit chart of account numbers. So assets are 1,000, liabilities are 2,000. Or there's 5 digits, or they're 4 digits, .01. So there's a lot of variety there. And so anyway, you're going to talk about the financial statements.
Just the relationship of the balance sheet accounts to the income statement accounts. So they are intertwined. The balance sheet includes your assets, liabilities, and equity. So the assets being what you own, and who owes you, like your receivables, your liabilities, what you owe to others, and your equity is essentially your assets minus your liabilities. What's important to understand about the balance sheet is that that is what's often requested by potential lenders to determine credit extension, credit limits that they would be willing to give to your entity. But the majority of non-accountants probably jump to the income statement first, rather than the balance sheet, which is your sales and sales of goods, sales of services, your income, and then your expenses, which would be big ones for all of us, would be payroll and benefits, possibly rent, subcontract expenses. So the income statement, while it's the fun numbers to look at of how much did we sell, how profitable are we, it's the statement that would be used by investors or outside lenders to determine profitability of the company, but the balance sheet would be what's used to determine your credit worthiness.
Right, so chart of accounts are the building blocks for the financial statements. There's actually a core financial statement not on here, which is the statement of cash flows. But so income statement is going to be more historical in nature. Balance sheet is more future oriented because it's a snapshot as of a point in time, as far as where you're at.
The financial wellness.
Right. So that's why I personally will gravitate more towards the balance sheet, because that gives you an idea of what the future is going to look like.
So it's also important in the contracting world to get a good handle on direct and indirect costs. And so that starts with setting up accounts in your chart of accounts that are adequately detailed so that you can monitor those categories. And direct costs would be your typically variable costs that fluctuate as sales volume increases or decreases. So the higher sales goes, the higher the cost. It's typically a direct cost associated with producing the product or fulfilling the service obligations to the customer. So it's directly related to satisfying those obligations. And then indirect costs would be typically fixed costs that remain the same over a reasonable range of sales. So they're expenses that have to be paid regardless of sales volume. So whether you sold 15 million or 50 million, your rent expense might be the same, for example. And indirect costs should be allocated to the direct cost of each job. And you will always want to look at the bid for guidance of what classifications are.
Yeah, so within that indirect cost pool, there are jobs that are more like variable overhead that pertain to jobs. And then there are more that they're more like office G&A, like your office workers. And so those are going to be definitely fixed. But the key is that if you do have job overhead and the project manager can generally control those costs, they should be allocated to the job as if they are a direct cost.
The most important piece being that they could be monitored by the project manager or for your job cost reporting so that what costs are associated with pursuing that contract or that job.
Right.
So let's test our knowledge. So a rental of a crane for a specific job site, direct or indirect?
I'm going to say direct.
You are correct. An accountant's salary. I hope we're all tracking here. Copier expense.
What kind of business is it?
They're producing prints.
Indirect.
Yes. Electrician wages when an electrician is one of your subcontractors. I had to clarify that.
There you go.
Building department permit fee for job.
Direct.
And warehouse rent.
Indirect.
A training course.
It's got to be indirect.
Even if it's driver safety training.
Probably, well, yes, it's indirect, yeah.
You passed. And sheet steel for a project.
Direct.
Okay, I think we have the idea. Thank you.
But you can see how it can change based off of the industry and what type of work you're doing too.
Correct. So what is this big warning?
I don't
sign?
know. I've been caught off guard here. This warning graphic has got me like a deer in the headlights here, so. Okay, so next up is a comprehensive example that I put together. What it does is it shows, basically it's a percent complete calculation for long-term contracts. You can go ahead and switch it. So if you're not really familiar with long-term contract accounting, this can be a little bit complicated. So what I suggest is that after this presentation, you can always take a look at this and then send me an email if you have further questions. But what I'll do is I'll just go through the whole example from start to finish. So here's the facts. So you bid on and win $1 million contract on January 1st, 2024. In your bid proposal, you estimate direct and indirect costs are $800,000. So your total estimated gross profit is the difference, which is $200,000 when the job is completed. You estimate the job will be completed 3 years from now, on December 31, 2026. And after working for 2 years, so that's when you bid it and you submit your bid and you've won the job, right? So after working for 2 years because of delays.
Is it governmental work?
Well, yeah, so
There's delays.
surprise, you might get to if you have a government job. So because of delays, you've incurred only 40% of your total estimated costs, or $320,000. And you have billed out 700,000 to date, all of which has been approved. So you've billed out 700,000 of your 800. So you've actually been able to bill out quite a bit. It's all been approved by the project owner or the general contractor. In addition, as of 12/31/2025, you have a $200,000, or you have $200,000 in uncollected billings and owe vendors and subcontractors $100,000. So the question is, in light of all that information, how much profit have you earned on the job as of 12/31/2025? So there's 3 different ways to look at this. So the first way is on a cash basis, how much did you earn? So you collected cash of $500,000 and you paid cash of 220. So you made 280.
Cash
So-
in hand.
Right. And so cash is how you emotionally feel, right? So emotionally, you're going to feel like you're rich and you've made $280,000. Accrual basis, it's basically the same thing, except it's based off of billings and POs with vendors and subcontractors. So under that model, you still have made quite a bit. You've made $380,000. So generally, so then the third method is the percent complete calculation under GAAP, which is acronym that stands for Generally Accepted Accounting Principles. And so under this calculation, you calculate the percentage of completion and how much revenue you should earn. So since it's 40% complete, you're only going to earn 400,000 in sales, and you've incurred 320,000 in costs. So it's really, you've only earned $80,000. So it's much more closer to break even. And it's the economic reality. So you feel like you're rich, but the economic reality is that I have work to do.
You're basically 2 years into a 3-year project.
Right.
And you're only recognizing $80,000 of gross profit at that point.
Right. And you got 60% of the work to get done in year 3. Like, it's going to be tough. So you've been getting pushed back. So this is a nice comprehensive example, because there's a difference between how you emotionally feel and the economic reality of what's really going on. So.
Well, and the point for the next slide is the difference between cash basis, which is cash paid out and cash in hand, feels far different than the accrual basis, where you have profits recognized, but you don't have the cash in hand because people still owe you and you still have not paid vendors. So you feel rich, you're waiting to get paid, but the cash flow is not there. And that's what we want to talk about.
Right.
So that
That's a nice segue right there. I like that.
it's almost like we knew what was coming next. So we start out on this journey winning this big contract and we think we're gonna be on this sunny road, straight path in our little sports convertible in ideal driving conditions, making progress on completing this contract. And pretty quickly we learn we've taken a different exit or a different turn and we're into the S curves of cash. And so the S curves of cash are the reality of the timing of when you have expenditures and when you have collections. So on this graph, the red line is the cash that outlays that you have to make. And so at the outset of a big contract, you see a spike in the red line because you're paying for materials. You might even be buying big pieces of equipment specifically for that job. There's a lot of expenses that you're incurring to get started on the work, and you can't bill it out for some amount of weeks, which is the green line that shows you're gonna collect, but there's a gap between the top red peak and the top green peak. That is your cash flow cycle. And the idea is to compress the green and the red peaks as close together as possible so that you aren't carrying the cash flow of the gap between those peaks. That valley is your cash flow cycle. So things like requiring deposits on order is one way that contractors bring in the cash flow from a green closer to the red. And trying to time and delay your expenses is another strategy so that you're just trying to compress the green and the red to line up. And then think about also if you have subcontractors that are on a pay when paid basis. If you follow this graph, you've got the first red investment peak and then a lull. You have the green cash coming in. And then you have another spike of the red expenditures out, which is paying your subcontractors once you got paid. And then you're tapering off on your collections from that project, and at the end, you're expending more. The red line is going up again because you're gearing up for another subsequent project. So it's always going to be navigating S curves over time. And the best thing you can do is try to pace yourself on the disbursements and time your collections and your contract terms to collect the green line as close to your red line as you can. That's the best strategy. And also to make sure that your green comes in higher than your red, that's your profit. So
that would be a good thing.
That would be a very good idea. To help monitor that, we've provided you with an example cash flash, kind of a rolling, ideally I would do a rolling 12 or 13 weeks. And I just kind of cut off a 6-week glimpse here to illustrate the point that you want to, first of all, plan what your expenses are. It might be materials or inventory purchases and when they're going to hit in which week. I would do it by week. Freight and delivery can sometimes be large expenditures. Operating expenses are usually known and you can pace them out, whether that's software or rent expense, and then subcontractor payments. So that you have by week an idea of what expenses are likely to be coming due and dispersed. And then another big category worth noting separately is payroll and the associated benefits and how they hit. That might be weekly, that might be bi-weekly. And then lastly, projecting your deposits. So you have some idea of what your billing cycle is, the pay history of your accounts. You know, if you tend to bill them monthly by the 5th of each month and they always pay by the 10th or the 15th of each month, then you can project out what your incoming customer deposits are. And then you may also need to project any advances from an operating line of credit or infusion of capital from investors. So you want to always be looking out ahead as things become known. You're fine tuning those numbers as they're getting into the short-term weeks in front of you. They're a little more slushy and unknown as you go out in the 12th and 13th week, but as they become known in the next month or so, 4 weeks out, you're starting to get a very firm idea of what those payments and collections will be, so that you can calculate your ending cash position. This isn't a cash reconciliation. This is a cash flash, a cash projection. And so, for example, if I'm looking at this data in front of me, I see that at the beginning of April, I'm going to be short of cash if everything goes according to what I'm planning. You see the red negative 36.5. So what that might mean for me is I go, do I really need to make that inventory purchase the first week of April, or can I push that out? Maybe I don't need that $50,000 inventory purchase that particular week. If I could push that out a week or two, then I'm covered. Or maybe I say, I need to lean on my collections efforts so that I'm getting some of those projected deposits in a little more aggressively. Maybe I need to work on contacting my accounts and making sure I can get payment commitments sooner than later and not be as relaxed about when they're paying me. So it's a good graphical way to keep looking ahead at what your cash position is going to be.
Right, so that, I was just gonna say that negative 36,500, to me, that basically means that you're dipping into your line of credit with the.
Would be my only other option to plan for if I
Right.
can't. If I can't balance the equation by pushing out expenses and pulling in collections, then my other option is where am I coming up with the extra cash shortfall?
Right, so if you're dipping into your line temporarily, it's not the end of the world, right? In fact, I mean, I'm thinking of my clients, I mean, all of them dip into their line at some point throughout, just because of the seasonality of construction, right? And making payroll, and I mean, some of my clients get paid net 60, and you know, if you're doing government work, I mean, guess how often you're gonna be paying your employees? You're gonna be paying them weekly, so yes, this is really important.
So what if you need to secure outside financing? Are we going to talk about that? We will, hold that thought. So maintaining good records allows you to monitor and analyze your business results and trends. It doesn't always mean we're monitoring when things go wrong. We're monitoring when things go well and do more of that. We want to support data-informed business decisions. You may forecast, you may look at a bid, you may put together your estimate, and you may realize this doesn't pencil out. If you really understand your costs, maybe you don't choose to pursue that. That's a go or a no-go decision that you really need to understand from good record keeping. It allows you, as we just pointed out, to budget and project your cash needs. And therefore, if you need to obtain bank financing or an operating line of credit, you must have good records to go to a financial lender and present your case to have them approve you for some operating loan or financing. Also, you need to consider for these larger projects, you're going to need to obtain the required bonding and insurance. And guess what? They're going to ask for your records, for your financials. And even in some instances, depending on volume and situation, you may likely need to comply with a reviewed or audited financial at least annually. And so be prepared that that is a level of scrutiny of outside eyes looking on your financials that you need to make sure you are putting the best foot forward with maintaining good records. So just know the sequence of events that lead up to needing to share your records with the outside world. And of course, then for the benefit internally is that you're tracking costs accurately. You can be more accurate in your estimating and bidding. You can submit timely and accurate tax returns and estimated payments, because we don't want to produce more cash than needed for estimated tax payments if we really know accurately quarter by quarter how the business is doing. Then we can be smart about making the right size payments. And we will then talk about how you have to report payroll details to comply with prevailing wage rules. So more on that.
Yeah, the submit timely and accurate tax return estimated payments, that's just, That's just what I do. So I'm not able to do that though, if the underlying information is not there, right? And my goal is to not surprise anybody with an estimated payment or an extension payment. But if the information is not there, then there's not a whole lot I can do, So. Okay, so on to public work requirements overview. So I'll just talk briefly about requirements to bid, prevailing wage requirements, and what prevailing wage is. Identify the required, how to identify the prevailing wage rates, how difficult it can be to actually calculate what the prevailing wage is. We'll talk about certified payroll and work completion documentation and where to go to get education for prevailing wage.
This sounds exciting. Tell us
Yeah.
more.
Okay, so there's a lot of acronyms on this slide. So part of government is that there's a lot of acronyms to deal with. In order to bid on government work, there's a lot that you need, right, up front. So there's the UBI number, which is through state of Washington, current contractors registration or licensing, industrial insurance coverage, workers' comp insurance. You have to be registered with Employment Security Department of Washington. You have to be registered with Washington Department of Revenue. Completed L&I required training. You have to certify that you're not a willful violator of labor laws in the past. There's apprenticeship and bonding requirements, and you also have to show that you're not currently debarred in Washington. And then specifically for government contracts, they have their own registration. So there's a lot of small business set-asides per contract that are based off of NAICS codes. So you have to figure out which codes you apply to you.
It could be multiple.
Right. And it could be multiple. There's also a unique identity number, also used to be called the DUNS number. There's the System for Award Management, SAM, and Commercial for Government Entity Cage Code. So, yeah,
That's
all the goodies.
And those specific things are for federal contracts.
Yes, they are. Yeah.
So you just- Federal contracts. The other stuff before it is for public works.
Right. Yep. Okay, so now we'll talk a little bit more about prevailing wage and how it's calculated. So basically the way it works is that your employees have a base wage that is more or less, unless they're union, if they're non-union, is going to be far less than the overall prevailing wage. And so the difference between that and their benefits is called the prevailing wage fringe. So-
Base plus fringe can add
Right.
it in, can meet your prevailing wage total requirement.
Correct. Yes, that's right.
How is it determined?
It's a good question. That's a very good question because
That's
sometimes
the
it's
hardest
really hard to
part.
figure out. And sometimes you have a variety of wage classifications and per employee, and it depends on how they're coding their time. Maybe they're hopping around different locations within like a single day. So hopefully everybody's keeping accurate time on what they're doing and which jobs they're working on. So there's the prevailing wage rates are determined by Washington L&I, and I believe in Oregon they're determined by BOLI, which I'm not sure what that acronym stands for.
Bureau of Labor and Industry.
Right. Federally funded public works projects are subject to the federal wage rates established by U.S. Department of Labor under the Davis-Bacon Act. So there's the federal Davis-Bacon, and then there's also state Davis-Bacon laws as well. That like it basically is Davis-Bacon flowing down to the states.
That's bacon bits, mini
Yeah.
bacon.
Yeah, that's good. That's nice. Okay, and then another important strategy to use is if you have residual fringe above the base wage, what you can do is contribute that to a 401k plan and help save the employer, help you save payroll taxes rather than just paying cash to the employee and having to pay all the payroll taxes on that. So that can be,
If you're above and beyond the fringe, the residual above and beyond the requirement, you can
right,
contribute that to a 401k plan and save the employer
yep,
portion of the payroll taxes, which is a good tip.
yes. Considering how expensive it is to pay the prevailing wage, you get a consolation prize with savings on payroll taxes for putting into their 401k plan instead.
So how do I know if prevailing wage applies?
If you're working on government work, it's gonna apply.
Any project funded by
Right.
public dollars, taxpayer dollars, so it could be state or federal.
Yes. And even if you're a subcontractor that doesn't have a direct government contract, it doesn't, so if you're working with a GC, if it's a government job, you're still gonna, be subjected to this. Cause it's gonna flow down. I think that's all.
So where do I go to learn a little bit more about prevailing wage requirements? I can go to L&I maybe,
L&I contractor portal.
and they also.
3-hour class.
Yes, they do. Or there is an exemption from that training. If the contractor, if you've had a active UBI for 3 years and have performed work on 3 or more public works projects for which you were previously certified, then you're exempt from recertifying.
Yeah, and again, I guess this is another slide on identifying correct wage rates. You need to know the type of work, where it's being performed, the effective date, because they'll change the rates throughout the year. So you have to update yourself on as they change.
Just when you think you've got it.
Right. You gotta stay on your toes, you know. So yeah, this can be a difficult process, and with certified payrolls, they need to be correct, because if they're not, I mean, you can be barred from bidding on government work for a long time. So you know, it's really important that all this is 100% correct.
And beyond the job classifications, there's a couple more categories to consider: apprentice and journeyman.
Right, so there is a difference between apprentice and journeyman. You know, if you're paying somebody on a journeyman scale, make sure that they actually are a journeyman. Just common sense stuff, but you'd be surprised, I mean.
Well, and it's
So-
back to maintaining good records so that you can prove it and produce the backup. Because there is more documentation and reporting around prevailing wages.
Yes, there is. Right, so this gets into certified payroll, so the employer certifies the payroll and submits it, files it with the Department of Labor, Federal Department of Labor. So again, it needs to be right.
So I'm presuming this slide deck will be available to attendees. So we've tried to embed the working links into the presentation so that you can go look for more information with video instructions and written instructions. So just like Alex said, that could be a whole session on its own, and I think there
Right.
will be a follow-up session through this series that you can follow up with and learn more.
Right.
And the other documentation relates to the work completion. And checking on your subcontractors to make sure, as Alex said, that if they're working on a public works project, they're not exempt by being under a GC. They have to comply as well and do their filing. More links for further education and training, and I would say Washington L&I is very helpful and has a lot of good material to make use of. Anything more on that?
No, I don't know if I have much to add on that one. Okay, so here's just some extra considerations when working on government work. So especially as it pertains to the I-5 bridge, you now have Jones Act and potential maritime law considerations. So there is a possibility that your L&I is not covered because you're under a maritime law circumstance. So you may need to have a private plan, and the overall cost of that is a lot greater than what you anticipated in your bid. So that's something that definitely look at, if you're working on public waters. Not allocating indirect costs to the job. So earlier we were talking about that. It's really important to do that. You technically don't have a financial statement in accordance with the standard unless you have an indirect cost allocation. I mean, so it's really important. And again, if you have trouble on understanding what to allocate, my rule of thumb is the project manager should be able to control all indirect costs, right? So if they can't control those costs, it doesn't make sense that they should be allocated to the job. And then on government contracts, governments don't pay state sales tax, just to let you know. And so you cannot use your reseller permits. So if you're a sub doing wholesaling activity, you can't present your reseller permit to Home Depot and get out of paying sales tax. So you need to make sure to equalize that, because the government doesn't pay sales tax, you have to pay sales tax when you go and purchase materials. So you got to make sure that's covered in your bid and not get caught off guard there.
We should have put another warning label on that one.
There's a lot of warnings on the slide. So for subcontractors, not believing the the government contract with the GC actually applies to them. You need to look at your contract and see if anything flows down to you from the GC's contract. And those are called the Federal Acquisition Regulations. Some of those provisions are really scary, like government can shut you down for the convenience of government, which I don't know how that's possible, but it's a thing. So just make sure that you have a good attorney there. And then my final point is, when you're working with government, it's so I work a lot with the IRS, right? So they always operate on form over substance, not the other way around. So you got to make sure that your ducks are in a row and your T's are crossed and I's are dotted. Really important.
Very literal, not about what was intended.
Right. Yes.
Thank you, Alex.
Sure.
So if we make it through all the S curves of bidding and estimating and certified payroll, then we get to monitor the financial results. And so this takes discipline in the day-to-day firefighting and running the business. Have the discipline to create a daily or weekly routine to stay current. Don't let it get away from you. Don't let it go untracked and unmonitored. For example, job cost reporting at least weekly to track actuals versus what you estimated. And that is your window for PMs to be watching and asking questions about variances. And maybe it's just in the wrong category, cost type, or phase, and it just needs to be corrected. But that trail is warm on a week-to-week basis. If you let it go 60 days, it's hard to remember back to what was happening, and it's a bigger task to track and correct. So project managers should also be very disciplined about processing change orders and updating their cost to complete on a timely basis, because this affects your WIP percent complete and the amount of revenue you either have to defer, pull back, or can recognize. And so again, it's not the favorite thing of everyone to be chasing purchase orders for different approved change orders and updating estimated cost to complete. But if you don't, you're going to get S curves of revenue recognition, which you just want that to be accurate as you go, so that we rely on project managers keeping current on all of that information and feeding that back to the accounting and finance team. The other thing that's important to do with looking at your financial results, whether it's the job cost, the balance sheet, the income statement, is to follow trends and question discrepancies. So there is no stupid questions. If you're seeing something that does not intuitively make sense to you, you need to be probing and getting answers that have good explanation and not vague responses, because that is your first line of making sure things are being recorded properly and accurately and timely. So I can't stress enough, just be accountable and discipline to view and recap your financial results monthly, job costing weekly, and ask questions about the line items that don't make sense or seem like they're an anomaly or an outlier, so that it's either explained that it was a one-off situation or it really just needs to be corrected.
Yeah, my biggest thing there is the business owner needs to be involved with this. So the business owner needs to be involved with monitoring financial results. If you don't understand financial statements, you need to learn how they work. It's really intuitive after a while. And what I see a lot of is, well, I know the business and I know the trade that I'm in. I don't want to deal with this, and that's why I've had this person to deal with it. But I feel like the business owner needs to understand how this all works, and it's really not that hard. I mean, so I think it's really important.
So the other thing we wanted to share is working capital chart. So I guess I'm a big proponent of, while we're accountants by trade and we like tables of numbers, I think a picture speaks 1,000 words, and I really like graphing some of the financial data so that non-accountants could be sitting across the room and see a graph and understand what story is being told by the graph. And so one of my favorites that's really pertinent to the construction and trades industries is the working capital chart. So your working capital components would include your cash, your line of credit, your accounts receivable, your accounts payable, and your inventory. And I just picked a snapshot of sample data that I think is relatable from the time frame of the COVID shutdown through post-COVID supply chain issues that we were all experiencing. So if we look at the green is cash, and about the first quarter in on this graph, somewhere around May 2020, in this particular organization of sample data, there's a huge infusion of cash. What might have happened in early 2020 that would have provided that huge infusion of cash? Well,
PPP loans.
bingo, PPP loan proceeds. And how did we emotionally feel? We're rich, we've got cash.
Well, you felt rich, and you turns out you were rich.
So that's where the green, all of a sudden we have cash. Our line of credit balance is non-existent. We're not borrowing. Our payables, what we owe to others, starts to go down because all of a sudden we have cash to get more current with our vendors and pay them down. So you see that it's coming across as kind of flesh colored in this color graph, but that front line starts to taper down. By the end of 2020, we're in a much lower position of owing others. And we start to see purple, which is accounts receivable, because we start to experience, strangely enough, throughout the pandemic, we were essential workers and we had a very solid business going. And so all of a sudden our picture is a lot healthier. Lots of green, lots of cash. We have purple outpacing the yellow, which means receivables are higher than what we owe to others. So that it was not that way at the beginning of the graph as we started 2020, but by the end of 2020, it's a much healthier financial picture. And so as we look forward into 2021, we kind of continue that pace. And then curiously, the green or the blue, which is inventory, starts to creep up. Why would that be in the time frame of 2021? Well, you could not, it was supply chain delays,
Right.
Global supply chain delays, and even the transport companies just getting products delivered if your supplier even had them. So what was the strategy? The strategy was, I better stock up a little more buffer in my inventory so that I can keep things moving in the business when I need the product. So you see that we started to increase inventory in that time frame to probably another $1 million significantly. And what happened to our cash? Well, the cash went into inventory. So we see that the green dropped off and the blue overtook it because that was a strategy for managing supply chain disruption. So this is just an example that I think the drivers were kind of relatable to all of us from that time frame. I would suspect a lot of business graphs would look that way.
Right.
But it's important to capture the uniqueness of your business and the significant events that transpire that impact your working capital. And you want to see a slice of the graph that indicates you're on healthy, good financial wellness footing and that you're poised to capitalize opportunities like public works projects that are coming along the pipeline, and that you're ready to pursue those, and that you've got the financial health in your working capital availability.
Mhm. Very nice. It kind of reminds me of Hawaii, to be honest. That graph. It's nice, have the little mountain, the leeward side and
You
then
can
the wayward side.
Spruce up the graphics. All right, so that brings us to building an advisory team, because you can see there's a lot of areas to navigate, and it's, you know, it's impossible to be an expert in all the little nooks and crannies of the various requirements and situations that may arise. So of course, at the top of the list, we suggest a CPA would be essential. And a good banker, because you want to establish banking relationships before you desperately need them. You want to have that good connection or multiple connections. A good banker will follow your story and follow your business like a good case study and become familiar with your business seasonality and your working capital fluctuations and requirements, so that when you formally ask, they should already be familiar with what's happening in your business. A good insurance broker is also recommended. So you're going to have specific insurance requirements for large projects and for even your own licensing for your respective areas of contracting. Oftentimes an insurance broker may also cover surety bonding as well, or you may have a separate bonding agent. But those are essential. You can't pass go without tax compliance, lending and operating banking arrangements, insurance and bonding. And the attorney. You can't operate without a good attorney, whether that's coming up with a good subcontract agreement or contract review, or navigating stoppages that are unforeseen. Like,
Right.
there's just,
Could you imagine going through COVID without a good attorney
no,
or nobody to talk to? Like, what's the world is ending?
that'd be lonely.
That would be rough.
And by the way, the attorney should be very familiar with construction law, I guess.
Yes.
There's, you know.
If you're gonna do public work, yes.
Yes. The other one we have put on here is software consultant, and that you may question, well, like, what does that mean? If you're pursuing growth and tracking public works projects, you probably are beyond the basic QuickBooks. You might be into some Deltek, Viewpoint, Spectrum, construction specific software that will help you automatically with job costing. It can spit out automatically certified payroll reporting. It will link to your payroll to track all the prevailing wage requirements. So look long and hard if your software that you're currently running will adequately support the records that you need to keep. You probably want to explore, if you aren't already running construction specific software, because it just foolproofs a lot of the record keeping for you. And payroll service. You may be doing internal payroll in-house. I would highly consider using a payroll service that is familiar with requirements needed for integrating with job costing or providing certified payroll reporting. Just be aware that there are those services out there that could help augment your expertise and team.
Yeah, then there's the financial advisor and the 401k third-party administrator. Those are important just because, like we said earlier in prior slides, if you have a fringe, from the prevailing wage, that you can set up a 401k plan and get tax benefits there. So another thing I wanted to add about this list is, it's really CPA, banker, bond agent, attorney. So bond agent is going to cover the insurance and also the bonding. Bonding and insurance are not the same. So insurance is like your typical insurance. You pay a premium and you're covered. Bonding is more like a line of credit. So bonds act more like as if you're a bank with a line of credit. And you can get on a bond line for free, basically. I mean, you just establish yourself with the bond agent, and you can get on a program and I believe not incur any costs, because the cost is incurred when you actually are going to post a bond. So it's really important to be proactive there. And my next comment is, having all of this professional help is not cheap. I mean, it's definitely expensive, and there comes a point in everybody's journey as a business owner where they look at this and they look at the cost and they go, I just don't know. And I understand that. And it is kind of like a leap of faith. But what I will say is that if all of these things are in place, this professional team, it is powerful, and the benefits are going to outweigh the costs.
I think the equally important question is not, well, how much is that going to cost me? The inverse question is equally important. How much is it going to cost me if I don't have that covered? Because the risk and the liability that's sitting out there is probably far more costly than the professional services fees.
Yes. Yeah.
So, words of wisdom, common mistakes or pitfalls. So this is not the time for DIYers. Going it alone is not recommended. There is way too much navigation to do a very specific processes, requirements. It's just,
Right.
Yeah, compliance. And the cost of not being compliant is far worse than the cost of making sure that you have the right services to be compliant. So penalties are never favorable. Forgetting to track reimbursable expenses is a common mistake in the flurry of just getting something purchased and like forgetting to track reimbursable expenses to the business and running it separately through the business. Also, not properly registering or licensing with all required agencies, whether that's business licenses or different contractor registrations. You need to be aware, you need to be looking out of where the required agencies are that you need to register or license with. And you like the employee topics?
Yeah.
Not properly classifying employees that's a big pitfall. And it is hard when certain employees may be bouncing around between classifications, but do your best. Not recording payroll entries timely, because that's where we're not just trying to record and classify transactions. We need to monitor and make sure that they are actually accurate and catch the misclassifications or catch the errors timely. So that also leads us to reconciling the books with the bank statement at least monthly, because the buck stops in the bank rec. And so that also catches errors or omissions. Not keeping backup for disbursements, not saving receipts of less than $75. I mean, that's a position people take. It's a bit risky. It's not keeping good records to substantiate your expenses and backup for, believe me, you will be asked by somebody to cough up documentation along the line.
Oh, yes.
Paying for things in cash and not keeping a clear trail or not keeping supporting documentation of those expenses that are bought in cash. There's reasons that you have authorized people to use cash for purchasing. But then just make sure there's a clear policy and process for providing the supporting documentation. And then lastly, it kind of brings us back to where we started, which was talking about the chart of accounts. Poor categorization or over categorization. So there's a balance. Sometimes having too much detail in separate accounts in the GL is too much of a good thing. It becomes unwieldy because it's too detailed. In the other end of the spectrum, if we just call one line item office expenses, I don't know what that includes and how do I know what's going in there and to monitor it. So you might have some further detail and not too summary. So it's a balance to be aware of.
Yeah, I mean, I think it's common sense, but you don't want to, you gotta think about who's keeping track of all the information that goes into all these little accounts, right? So, you want it to be comprehensive and cover everything, but not be so detail oriented that your internal accountant hates you.
So we also want to leave you with but wait, there's more resources for you. So, again, these are live links. If you get the PowerPoint, you'll be able to navigate these. So I think we'll leave it at that. We just want to make sure you're aware of state resources, some trade associations that are very much applicable. So we've put a lot of those on here. There's other things like the Apex Accelerator, the CREDC, the Greater Vancouver Chamber of Commerce, and SCORE, Association of Washington Business. These small business development center, all of these have programs who aim to support businesses pursuing different, like pursuing public works projects, pursuing business growth, that make use of these resources.